Is the economy on a collision course with the housing market? A question that has been swirling around in the minds of many. Yet, an analysis of the complex relationship between these two entities may reveal otherwise. Firstly, it's important to understand the fundamentals. The economy and the housing market are not two separate entities, but rather they are interlinked. As the famous economist Adam Smith once said, every individual neither intends to promote the public interest nor knows how much he is promoting it. He intends only his own gain. This concept applies to the housing market as well. When individuals invest in real estate, they are indirectly fueling the economy, leading to growth and prosperity. But what about the doom and gloom predictions we often hear? The potential for economic downturns, inflation, or unemployment to tank the housing market? Well, let's delve deeper into this. Renowned economist Paul Krugman provides some perspective. He argues that housing markets could decline not because of a weak economy, but due to their own internal dynamics. This means that factors such as supply and demand, rather than the overall economy, are the primary drivers of the housing market. In other words, even in times of economic turbulence, the housing market can remain robust because of its inherent resilience. For instance, during periods of economic uncertainty, people still need homes, and investors still seek tangible assets. The demand for housing does not evaporate overnight. Robert Shiller, the Nobel laureate in economics, further emphasizes this point. He states, "The housing market has its own momentum separate from the economy. It's influenced by factors such as demographics, interest rates, and consumer confidence. So while the economy and the housing market are connected, they also have their own distinct dynamics." Economic downturns might pose challenges, but they do not necessarily spell disaster for the housing market. In conclusion, the relationship between the economy and the housing market is complex and multifaceted. While economic factors can influence the housing market, they are not its sole determinants. The housing market has its own inherent resilience, driven by factors such as supply and demand, demographics, and consumer confidence. So the next time you hear someone predicting the downfall of the housing market due to economic conditions, remember these insights. The housing market isn't a mere puppet at the mercy of the economy. It has its own dynamics and can stand firm even in the face of economic headwinds. The economy won't necessarily tank the housing market. It's a provocative thought, isn't it? But remember, as with all things in life, nothing is ever as simple or straightforward as it seems. The relationship between the economy and the housing market is no exception. It's a dance, a delicate balance, and it can surprise us all.
Hi everybody, thank you for watching that small video I have put together for you guys. I hope you found it useful. If you are worried about a coming recession, you are not alone. Over the past couple of years, there has been a lot of recession talk. And many people worry if we do have one, it would cause the unemployment rate to skyrocket. Some even fear that a spike in unemployment would lead to a rush of foreclosure, similar to what happened 15 years ago. Economics are turning optimistic on the US economy. Economists lowered the probability of a recession within the next year from 54% on average in July to a more optimistic 48%. That's the first time they have put the probability below 50% since the middle of last year. If over half of the experts no longer expect a recession within the next year, you might naturally think those same experts also don't expect the unemployment rate to jump way up. And you'll be right. Data from the same Wall Street Journal survey to show exactly what the economists project for the unemployment rate over the next 3 years. And that's the graph we are just looking at together. If those expert projections are correct, more people will lose their jobs in the upcoming year. And the job losses of any kind are devastating for those people and their loved ones. However, the question there is, will there be enough job losses to cause a wave of foreclosures that will crash the housing market? Based on the historical context from Macrotrend and the Bureau of Labor Statistics, the answer is no. That's because the unemployment rate is currently near all-time low. And as you can see on that graph, as the orange bar in the graph shows, the average unemployment rate dating back to 1948 is 5.7%. The red bar shows the last time the housing market crashed in the immediate aftermath of the 2008 financial crisis. The average unemployment rate was up to 8.3%. Both of those bars are much higher than the unemployment rate today. So that's kind of giving us the comfort that we have been talking about as far as the housing market crash concerned. Moving forward, the projection shows the unemployment rate is likely to stay beneath the 75 year average. And that means we don't see a wave of foreclosures that will severely impact the housing market. Now, guys, whether you are a homeowner, real estate investor, or simply curious about the economy's impact on the housing market, I hope the previous video and the information we just provided for you kind of helped to make informed decisions and navigate the current economic landscape with confidence. Hit the like button, share this video with your friends, and be sure to leave a comment with your thoughts and any questions you have. Stay informed, discover the truth, and let's debunk the myths together. Thank you for watching and have a great day.